Good morning, students. I welcome you to the 27th session of the Advanced Financial Management. This is Padmavati Indargi, Assistant Professor of Management from Government First Grade College, Devanahalli. Today we'll see one more capital structure theory under the modern approach, that is net operating income approach. The outcome of this session is to make you able to explain what is net operating income approach of capital structure theory. Regarding previous session, I have dealt with the problems based on net income approach, where net income approach states that the change in the level of debenture or debt leads to increase in the value of the firm and decrease in the cost of capital, where there is a relationship, there is a dependency exists between the level of debt and the cost of capital and market value of the firm, as stated by the David Duran in net income approach. With regard to that, we have solved the problems based on NI approach. Today we'll see what is net operating income approach. Students, net operating income approach is also given by the David Duran, where he explains the another extreme of the theory. In net income approach, he states that the capital structure decisions relevant like level of debt has impact on the cost of capital and value of the firm. But in this approach, net operating income approach, it is opposite to net income approach. According to this approach, the market value of the firm is not at all affected by the capital structure changes. That is, whether you increase debt to 50% or 75%, from 25 to 50 or 50 to 75, it won't have any impact on the overall cost of capital and the value of the firm. Value of the firm and cost of capital are independent of the level of debt. The market value of the firm is ascertained by the capitalizing the operating income. That is, market value of the firm is calculated. Market value of the firm is found out by capitalizing the NOI amount by the overall cost of capital, which is considered to be constant. The cost of capital is considered to be constant. With the level of change in debt will not have any impact on the cost of capital. So what are the assumptions of net operating income approach? First assumption is that the overall cost of capital remains constant, fixed for all degrees of debt, whether it is 25%, 50% or 75% of debt. The overall cost of capital remains constant. Next is, the market capitalizes the value of the firm as whole, and therefore the split between debt and equity is not as important. So the market capitalizes the value of the firm as whole means the value of the firm is found by capitalizing the NOI by the overall cost of capital. Next assumption is that the market value of equity is residue. That is, we calculate the value of equity by deducting the value of debt from the value of the firm. That is, value of equity is equal to value of the firm minus value of the debt. Next, the use of debt funds increases the perceived risk of investors, equity investors. So, KE increases. That is, when you change the level of debt, for example, from 25 to 50%, when you are increasing the debt proportion in the value in the capital structure, the equity investors demand more because they perceive it is high risk. They perceive it is risky to use the debt in the capital structure. They say they perceive that with the increase in the debt, the commitment of the business will increase. The business person has to pay more interest to the debenture holders, whether it is in profit or loss, it has to pay. So it increases the risk perception of the equity investors. So they demand more. So KE also increases. Next assumption is that the debt advantage is set off exactly by an increase in cost of equity, means whatever benefit we are getting with the increase in debt is offset by the increase in cost of equity. Here, cost of debt is also when the level of debt increases, it leads to increase in cost of equity. So whatever advantage it is providing by increase in debt is offset. Next, cost of debt remains constant, means the cost of debt to whatever level of debt or whatever level we increase the debt, the cost of debt remains constant, it is fixed. Next assumption is that there are no corporate taxes either in net income approach or a net operating income approach. There is no corporate taxes. The formula to calculate value of firm in net operating income approach, the formula that we use to calculate value of firm is EBIT divided by KO. EBIT means earning before interest and tax divided by cost of capital, overall cost of capital. So we'll get the value of the firm. Now to calculate the value of the equity, it is a residual value as we said. So value of equity is value of the firm minus value of debenture, will get value of equity. So according to NOI approach, there is no optimum capital structure because the total value of the firm, market price of equity share and cost of capital remains unaffected with the change in financial leverage, that is change in debt proportion. Let's have one problem based on NOI approach. XYZ expects a net operating income of rupees 2 lakh. It has 8 lakh 6% debentures. The overall capitalization rate is 10%. Calculate the value of the firm and cost of equity according to net operating income approach. If the debenture debt is increased to rupees 10 lakh, what will be the effect on volume of the firm and equity capitalization rate? So net operating income as given in the problem, it is 2 lakh. Overall cost of capital is 10%. So market value of the firm is EBIT divided by KO, that is 2 lakh into 100 divided by 10, that is comes to 20 lakhs. So market value of the firm is 20 lakh and market value of debenture as given in the problem, it is 8 lakh. So 20 lakh minus 8 lakh is 12 lakh. So that is value of equity is 12 lakh and equity capitalization rate formula is EBIT minus I divided by V minus T. So EBIT is 2 lakh as given in the problem minus 48,000, that is 8 lakh 6% debentures means it is 48,000 divided by 20 lakh minus debenture is 8 lakh into 100. So it comes to 12.67%. So V is value of the firm and D is value of debt capital. So students, this is about net operating income approach where the level of debt has no connection with the cost of capital or value of the firm. All three are independent. So it is a opposite theory of net income approach. NOI is opposite to NI approach. Thank you.